Ladies and gentlemen, good day and welcome to the Ujjivan Small Finance Bank Q3 FY24 earnings call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rikin Shah from IIFL Securities Limited. Thank you, and over to you, sir.
Thank you, Darwin. Welcome, everyone. We have with us today the entire senior management team of Ujjivan Small Finance Bank discuss 3Q FY24 earnings performance and the business outlook going ahead. The management team is represented by Mr. Ittira Davis, MD and CEO, Carol Furtado, Chief Business Officer, Ashish Goel, Chief Credit Officer, MD Ramesh Murthy, Chief Financial Officer, Martin PS, Chief Operating Officer, Vibhas Chandra, Head Microbanking, and Deepak Khetan, Head Financial Planning and IR. With this, I'll pass on the call to Mr. Ittira Davis to share the opening remarks and walk through the 3Q performance. Over to you, sir.
Thank you, Rikin, and good evening and welcome to our Q3 financial year 24 earnings call. FY24 Q3 has been yet another healthy quarter with the bank moving in the right direction. During the quarter, our loan disbursements stood at 5,675 crores, up 17% Y-on-Y, leading to a gross loan book growth of 27% Y-o-Y and 4% Q-o-Q. Microfinance business continues to witness strong ground-level trends, being an under-penetrated segment still. We believe the business in this industry has more room to grow, mainly due to increasing number of customers coming in the purview of lending, along with growing appetite for credit among existing customers. We acquired around 2.5 lakh new customers, taking the total count of newly acquired customers to 7.8 lakhs in the 9-month period as of April 23 to December 23. During the quarter, disbursements of our group loan and individual loan business were at 3,294 crore and 1,029 crore respectively, up by 7% or 45% year-on-year, but stagnant when compared to the last quarter. This was due to a higher number of holidays during the period, resulting in some loss of business. However, we have seen momentum picking up very well during the month of December and expect this strong trend to continue in the fourth quarter, which is usually our best quarter. One of our key focus areas is increasing our secured loan book contribution to our total portfolio. Our concentrated efforts have helped improve our secured loan book percentage to 28.3%, up 83 basis points versus the last quarter. Affordable housing, including micro-mortgages, which is our second largest and profitable business, continues its strong upward quarter-on-quarter. We dispersed 595 crores for the quarter, up 73% Y-o-Y and 10% Q-o-Q. As I had mentioned earlier, we are focusing on a hub-and-spoke model for the housing and MSME businesses. This has been beneficial in improving our business efficiencies and reducing TAT. Along with this, we have introduced state-wise collection policy for our micro-mortgages as we progress to enter into new states, and have also started offering new product variants for our customers in this segment. MSME business has started to pick up. Apart from offering secured products, we have onboarded 2 new fintech partners this quarter and started dispersing towards supply chain finance. Going ahead, we plan to expand our reach in this segment with our own supply chain finance distribution channels. The FIG business continues to expand its customer base and dispersed 379 crores in the quarter. New products like gold loan and vehicle finance are ready to scale up in the next fiscal onwards. We continue to expand our physical distribution network. During the quarter, we have added 29 new branches, taking the total branch count to 729, spread over 26 states and union territories. We aim to add 23 more branches in the current quarter. Also, we added 5 new hubs to enhance our retail secure business distribution. Coming to the liabilities, Q3 has been a very healthy quarter. Targeted initiatives like nationwide brand campaign, value-added liability products have started to yield benefits. Quality of new acquisition has improved by the fact that our average savings account balance for retail branch banking customers has started to rise, currently at 35,000, which was stagnant around 30,000 for the last 6 quarters. We garnered more than 500 crores of CASA this quarter, taking our CASA book up 8% quarter on quarter to 7,556 crores. Our CASA ratio also improved to 25.5 against 24.1 last quarter. This itself underlines the fact that we are focused to add granularity to the book. As we continue to moderate excess liquidity, total term deposits remain stagnant this quarter, but the ratio has inclined favorably towards retail TDs, which is up 9% sequentially. Further, I'm happy to announce that our long-term borrowing has received an upgrading rating of AA- stable from A+ or A+ positive. This has been very beneficial to access. This will be very beneficial to access lower cost borrowings and reducing our cost of borrowings in the future. Our recently launched application, Hello Ujjivan, is gaining acceptance among the customers, with total downloads reaching 5.9 lakhs and total repayments of more than 100 crores since its launch. The loan acknowledgement of our group loans has also started to pick up. A total of 80,000 loans were acknowledged this quarter. This serves a dual benefit. Firstly, saves the customer visit time to the branches, and secondly, reduces the pressure on our branches. Additionally, repeat loan facility will also be offered through the Hello Ujjivan facility in the future. Digital TDs has started its course, and we are exploring partnership with aggregators to increase the business volumes. In line with our digital strategy, we have started offering digital savings account from this quarter. This will further aid us in onboarding customers digitally and build savings account relationships in areas not falling in branch catchments. The financials and margins. Another focus area during the quarter was to bring down excess liquidity in the system. This provided some breathing room for our margins, which was under pressure due to rising cost of funds and excess liquidity. The rising cost of fund has also started to slow down, rising only 8 basis points against 23 basis points last quarter, indicating that our cost of funds has started to peak out. Our yields also improved sequentially as repricing of the book continues. As a result of 3 factors, lower liquidity, lower rise in cost of funds, and improving yields, we are able to sustain our quarterly NIMs. We will continue to reap some more benefit from asset book repricing, as currently around 65% of the book is in the highest bracket, while around 20% of the book sourced between September 22 and February 23, and 17% of the book sourced pre-September 23 is yet to be fully repriced. Having said that, our PPOP remained healthy at 457 crore, growing by 18% year on year. Coming to the credit cost and provisioning, we have been receiving many queries from the street on this topic. To answer this question, the aberration in terms of credit cost you had witnessed in the last 2 years, largely due to an unprecedented event in 1 year and a very good recovery from the event in the subsequent year, has now all but settled. Going ahead, our credit cost will continue to move towards the normal levels. We continue to improve our business processes, credit and collection policies. We can confidently assure this will draw more comfort from the quality of the book we have built over the period, supported by our strong collection team. Credit cost for the quarter is 63 crores as against 47 crores in Q2. PAT for the quarter was 300 crores. Ujjivan has been displaying strength in business and financial performance over a period of the last 8 consecutive quarters. This is highlighted by our ROA and ROE at 3.1% and 24.2% respectively for Q3 financial year 24, among the best in the industry. Our asset quality remains robust with the GNPA at 2.1% against 2.2% in the last quarter. NNPA remains negligible at 0.16%. Collections remain strong. This quarter saw some minor incidents like flash floods in Tamil Nadu and false loan waiver campaigns propagated in certain pockets of North India. But these were largely contained in limited districts and did not have any major impact at pan-India level. Slippages for Q3 were at 140 crore as against 113 crores in Q2. For the 9-month period, slippages are at 347 crore with upgrade and recoveries of 198 crore. Bad debt recovery remains strong at 105 crores for the 9 months. We have written off 93 crore during the quarter, a substantial sum from the non-performing MSME book. Now an update on the succession. As I mentioned in our last earnings call, the bank's board is working on identifying candidates and submitting recommendations to RBI. The process is moving ahead as per the set timetable, and I can assure you that a smooth transition will be made over the next financial year. Update on the reverse merger. Based on the order received from the Honorable NCLT, a hearing has been scheduled next week on 30th of January. We are confident that this will be the final hearing. Once the merger is approved by NCLT, we will proceed with the remaining procedural and regulatory aspects, expecting the merger to be completed by March 2024, by the end of this financial year. The outlook, we maintain our short-term and medium-term guidance given earlier this year. I would like to again add that the fourth quarter historically has been our best quarter for the year and should follow this trend during this year as well. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. We also request that you please restrict your questions to 2 per participant. For follow-up questions, you may rejoin the queue. Ladies and gentlemen, we will now wait for a moment while the question queue assembles. The first question is from the line of Renish from ICICI. Please go ahead.
Yeah, hi sir, and congrats on a good set of numbers. So just 2 questions from my side. One on the AUM growth side. What is our internal assessment for FY25 growth? Given we have been hearing that regulator is asking SFBs to sort of maintain the CD ratio is 85% odd, though we are very close to that. But do you see any downward risk to our guidance getting into FY25 because of the regulatory pressures?
Renish, hi. First of all, thank you. And we do not see any downward push to our guidance. We, in fact, mentioned that our guidance remains the same. Our CD ratio, as per RBI guidelines, is more or less in line around 85 only. I think 88 for this quarter.
Right.
And, we will grow in line with what we mentioned in June.
Got it. And secondly, on the NIM side, okay, I didn't hear on the let's say what percentage of the book is still yet to repriced at the higher rate?
So for the microfinance book, the GLIL book, 20% is yet to have a 50 basis point improvement, and 17% of the book is yet to have a 100 basis point improvement.
Okay, which will be in Q4 or Q4, Q1?
This will happen over next couple of months, few months. Q4 and maybe even a little bit in Q1.
Got it. So try to assume that NIM will sustain at current level at least for next couple of quarters?
We will continue to be strong, and we are working on cost of funds. If cost of funds, given they are flat the way they are behaving now, there should be improvement in NIMs.
Got it. And just last question from my side on the MFI book. We've been hearing from a lot of the industry peers that Punjab and Haryana is facing some problem, because of this Karza Mukti Andolan and all. And we have some, I think, 8-10% of our AUM in both the state put together. So are we facing any issue, or those issues has been now resolved and, the collection is back to normal in those states?
Hi. So yes, you're right that Punjab, Haryana, and some other part of the country also the Karza Mukti Abhiyan is going on. It is completely illegal, but at the same time, to affect to us is little limited because we are mostly present in urban and metro pockets. So affect to Ujjivan is little limited. At the same time, we are working very closely with AMPIN, which is a central regulatory body, and also RBI also come up with various documents around it, which we are working with various governments also, so that customer understand that this is something which is illegal in nature. So far, the effect of this is very, very limited in Ujjivan.
No, okay. And at industry level, I mean, let's say the collection trend which you might have seen in September, October, the situation is better in December, Jan, or it is still the same?
Our event is almost on the same line. We have not seen any substantial impact on our book. As far as industry is concerned, we have heard that there is some impact in some certain pockets, especially in rural pocket has happened. But it is at industry level also, it is not, at this point of time, it doesn't seem to be a very big challenge at this point of time, especially as corrective measures have been taken, and RBI also coming, and as RBI is coming, the various administrative bodies also helping to reduce the effects of this morcha.
Got it. Okay, that's it from my side. Thank you.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Congratulations on good numbers, and thank you for taking my question. So firstly, a couple of clarifications. So there is a sharp jump in employee cost. Is there any one-off? And second is on the insurance distribution income. It is yet again higher at 30 crore plus in this quarter. So has the run rate structurally changed after the commission changes?
Rajiv, on the employee cost, three things impacted it. One, there has been hiring this quarter. Second, there were some mid-year corrections given for certain employees. And third, the cost of ESOP is included in Q3 numbers. So these three has impacted. Cost of ESOP should be more or less one time. Rest is ongoing cost. That hiring also includes the new branch expansion that we did. 29 branches were opened. Your second question was on TPP income. There's no change in the structure. Last quarter, we have mentioned that some arrears were there because in Q1, the ruling came in August, and the arrears of Q1 were there in Q2 numbers.
Okay, so the reported run rate should hold up, right, in that case?
The reported run rate should hold up.
Yeah, understand. And just broadly on the loan disbursements. Yeah, on the loan disbursements. Okay, got it. And on the group loan disbursements, which has been modest, I think sir also alluded to things will improve in Q4. Because so that should come back very strongly in Q4, right? That's the expectation we have.
Yeah, that's correct. So apart from the holidays, there were a couple of other technical challenges also which impacted this quarter, early quarter in the month of October, November, and December. So which impacted the overall disbursement, which have been rectified, and we are seeing good. At least January so far, we are seeing as a good month.
Got it. And any reassessment of our long-term cost-to-income outlook? I know we are maintaining a long-term guidance of ROE, but given that you have done some media corrections so that employees' ESOPs can be given out slightly frequently, and hiring is going up. So would you want to kind of reassess or maybe reiterate what is the cost-income outlook for the next couple of years?
Rajiv, there is nothing that has changed course from our internal strategy. So when we met you around 8-9 months back in Mumbai, the analysts and the street, all these things were there on our plate. So we would not want to make any significant changes from that.
I just want to add to what Deepak said. When we grow our branch network and everything, there's a leading and lagging. So when we invest in the new branches, lagging effect is that we get inputs and returns the year or 18 months later. So that will, we have invested this year in about 100 branches, and that has increased the network. The benefits of that will come in the coming year.
Got it, sir. Thank you so much for answering all my questions.
Thank you, Rajiv.
Thank you. Ladies and gentlemen, we request that you please restrict your questions to 2 questions per participant. You may rejoin the queue for follow-up questions. The next question is from the line of Manish Ostwal from Nirmal Bang Securities. Please go ahead.
Yes, sir. Thank you for the opportunity. So my question on your capital adequacy slide. So our risk-weighted assets has increased almost 2,085 crores, whereas our balance sheet increase on quarter-to-quarter basis 850 crores. So can you explain what is leading to this kind of jump in the risk-weighted assets quarter-to-quarter basis, sir?
Manish, we have taken adjustment based on the recent RWA guidelines that RBI has announced. So that has also impacted a little bit on the risk-weighted asset number.
Okay. So can you quantify the impact?
The impact on CRAR, I remember, would be somewhere around 80 bps.
Okay.
Which has been already incorporated.
Okay. The second question on your comment in the press release, which is that we have reduced our excess liquidity during the quarter, and still our NIM is flattish compared to the last quarter. So I know our full year guidance is 9% we have maintained, and quarter 4 seasonally strong quarter, but logically excess liquidity should have some positive impact on the NIM. So where the disconnect here?
So for the 9 months, the NIM is maintained at 8.9, and we maintain that we will be around 9% NIM. So Q4, Mr. Davis mentioned that are generally the best quarter for the bank, and we believe whatever the next 2.5 months will be there for us will be good, and we maintain our guidance there.
Last one small data point. Can you quantify the ESOP cost one-off in the employee cost in the quarter? Thank you.
I'll have to check that and come back.
Thanks.
We'll take it offline.
Yeah.
Thank you. The next question is from the line of Pritesh Pum from DAM Capital Advisors. Please go ahead.
Hi, good evening, sir. Just a couple of questions. First of all, the PAR book seems to be a little plateauing compared to GNPA. Is there any rise in early buckets as well?
Yes, Pritesh, there has been a 15 bps rise in the SMA book as compared to the past.
This is largely due to, seasonality plays an important role in the months of October and November, other than there being a little bit of extra holidays. So I think that is what the numbers are showing. There is nothing other than these seasonality and holiday factors.
Okay, so nothing to worry. So this will of course come back basically in our books basically. Yeah. Second question was on this bad debt recovery, which we still are having almost like 31 crores. Is this from the earlier write-off pool only, and how much from that now we have recovered and how much is left? I think we had a 1,200 crore pool earlier. So how much is left to recover and how much has been recovered? And is there any potential recovery which can come ahead as well?
So Pritesh, on the bad debt recovery, normally the trend has been a recovery of between 25 to 30% over a 24-month period. And this has been consistent over the last 6 to 8 quarters. We currently have a book of about 800 odd crores, and the recovery in the first 9 months has been 105 crores. We expect that by the end of this, we will maintain a similar run rate for this Q4. Next year, again, I would say that whatever fresh write-off we have done, if you see the fresh write-off has been coming down. Last year it was in the range.
Sure. Sure. Last question was the new customer mix in the IL, individual lending. Yeah. So one last question was on the new customer mix in the IL. Sorry, can you hear me?
Yeah, yes, we can now. Now we can hear you.
Yeah, sorry. So I was mentioning the new customer mix in the individual lending. It's been consistently moving up. It's now 18%. Generally, we thought that this generally is a step up from the MGL to IL. So what will be the upper cap of that mix you want to generate from new customers, and how do you look at it as a portfolio perspective?
We would not want to put a upper cap anywhere right now. The industry trend is that IL is growing faster, and Ujjivan is one of the pioneers in the individual loan business. And we have been saying that this will pick up faster and this will be growing faster than GL for a very long time. This is just when the industry wants to catching up with what we need. So as of now, we'll leave it there. That group loans growth will be from new customer acquisition. IL will be growing basis the movement of existing GL customers to IL, and also new customer acquisition from markets, open market. So we'll leave it there right now. Also to add what Deepak said, you're right that historically IL was GL to IL phenomena, graduation of customers from GL to IL. But as industry is now old and we have great bureau information for about 10 years around the customers, the customers who are coming in open market also have experience in microfinance, maybe not with Ujjivan, but some other organization. And if you see practically they have experience and then they are graduating to IL. That way you can acquire the best customer, the team of microfinance customers, and that's how we are trying to grow. And we'll keep growing in the open market IL as we go ahead.
Got it. Thank you so much for your answers. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, I'm audible.
Yes, Deepak. Hi.
Yeah, hi. Thank you very much, sir, for this opportunity. So you mentioned employee costs were higher, 2-3 reasons. So one-off was the cost of ESOP. So what was can you quantify that cost?
I do not recall the number, but we can talk offline and I'll get the number by that time.
Fair enough. I mean, this will not reoccur, right? I mean, this is one-time cost.
So we have an ESOP policy that we issue ESOPs every year to basis the performance of the employee and basis the pool available.
Okay.
But issuance is done once a year.
Okay, understood. So, I mean, in terms of your total OpEx cost, I think this quarter our OpEx cost was close to about 587 crores, right? Which was a start jump from 529 crores that we have done last quarter. So, quarter on quarter we have seen a big jump in OpEx cost. So, is there any rationalization in this cost that can happen in coming quarters, or this is the base that one can look forward to?
One thing that I could mention is the ESOP cost. Other than that, it's mostly this quarter only, nothing major that is one-off or anything of that sort. But yes, in terms of rationalization that you are mentioning, as Mr. Davis also mentioned, there's a lead in the last, as the business picks up, again the cost to income ratio, if you're looking at the ratio, they will start to fall behind.
Okay. And 2 years, in next 2 years, what sort of cost income target we have?
So we have given our guidance in the month of June 2023. We maintain our guidance.
Okay.
Your business case due to.
It was sub 50%, right? That's what we had targeted, I think, 2 years, right? If I can recall.
We mentioned around 50%.
Come again?
We have mentioned around 50%.
Okay, inching around 50%.
We mentioned around 50 to whatever, 51, 52, we have mentioned that only. Actually, there was a lot of query that why we are mentioning that.
Okay, I got it. I think, just one last thing on the deposit side. I think in terms of growth, we have seen a lower growth in this quarter, right? I mean, because of the challenge that I think most of the financial player has faced in terms of garnering the deposit side, I mean liability side. So how do we see that going forward?
Our deposit growth being lower quarter on quarter, is that the question you are asking?
Yes.
Yeah, so it's 2%. That is because we have reduced our bulk deposit. If you see the retail deposits in the CASA have shown very strong growth. The CASA is up 8% Q1Q, and that is the focus of the bank. And it will be like that. And also we mentioned that we are moderating the excess liquidity. So that continued, and that is why we did not want to grow deposits too much.
Okay. Fair enough. I got it. Okay, I think that's it from my side. All the very best to you. Thank you so much.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team. The first question is on the asset quality. Can you just give a breakup of your slippages for the quarter across segments?
Actually, we don't give segment-wise slippages.
Okay. Okay, then coming to deposits, we have seen the term deposit rate being fairly constant over almost a year now for Ujjivan. Do you see a need to hike term deposit rates from here?
It's more of a market-driven phenomena. Right now, we do not feel any kind of pressure. This is the requirement that we have. We are seeing deposits coming in.
Okay. And on the outstanding term deposits, you would say that the repricing is largely completed?
To a large extent, it is. There will be some bit of a bunch up coming up next fiscal. By that time, we'll need to see how the rate cycle is there and what behavior we'll see in the market. We can't comment on that now.
Okay.
But I can say that the cost of fund has been stagnant for the past couple of years. There's been absolutely no movement.
Okay. And just lastly, on the microfinance business, how good is the demand on the ground from the borrower? And in that context, do you also see a possibility to take a further increase on the lending rate in the microfinance business?
So as far as demand is concerned, this is a cyclic thing. It happens every year. The third quarter is generally a little demand is on the lower side because of there are the school holidays. And also the demand because of the holidays actually coming in the month of July, June, July only, because very lead time is required. But last quarter is generally very good for the industry as far as also. And so far this quarter has been very, very good for us. And we hope to continue in the rest of the coming year. As far as lending rate is there, we do not see hiking anything here.
Okay, perfect. Thank you.
Thank you. The next question is from the line of Tushar Sharda from Athena Investments. Please go ahead.
Yeah, thank you. Thank you for the opportunity. I wanted to check, in terms of net profit growth with the credit cost coming back, how should one look at it? Would we have flat profits? I think that's what most of the brokerage reports are projecting.
So, Tushar, I can say that last year when we gave guidance for this year, we said that we'll have a decent net profit growth for this year, and we maintain that guidance. Even when we mentioned about FY25-26, we gave a ROA, ROE guidance, and we maintained this guidance.
Okay. Thank you.
Thank you. We have the next question from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, as per our guidance for FY24, we were to grow our loan book by 25% and deposits by 30%. So, which means for next quarter, we have to grow our loan book by, say, 9% and deposits by 12%. So, is this doable?
So, deposits, depending upon how much we require, will be there. And Q4 in terms of disbursements are good. So, a basis here and there, I would not be able to comment, but overall Q4 will be there.
So, we can see a higher single-digit growth in our loan book?
Sorry?
We can see a higher single-digit growth in our loan book for Q4?
You can see a good growth in the next quarter. I would not want to say high single or low single, but Q4 is a good quarter for us.
Okay. And, sir, any guidance on the NPA front, where we would like to close FY24?
No. In the beginning of the year, we said we would be in the range of 2%.
Sorry, I can't hear you.
At about
Sir, sorry to interrupt.
But, are you able to?
In between, sir.
We are not able to hear you.
Okay. So, in the beginning of the year, we had said that we would be in the range of 2%. Currently, we are at 2.1, and we expect that we will be in the same range, in the range of 2%.
Okay. And so finally, any update on our floating provisions? I mean, we still have about 250 crores of floating provisions, which is still unutilized. So, what would be the update on the same?
We continue to have floating provisions of 250 crores. Now, this is about 0.9% of our overall book. This will be used in terms of, whenever we have any contingency in the future. This floating provision is to cushion our balance sheet from any future one-off instances or events on any unforeseeable one. So, this will carry for at about 1% of the book, actually 0.9% of the book.
Okay. That's it from my side. Thank you and all the best.
Thank you. The next question is from the line of Vivek Ramakrishnan from DSP Mutual Fund. Please go ahead.
Hi. I have two questions. Picking up on the earlier question on the individual loan, how much would be new to credit or new to Ujjivan? And given that, I understand you're not placing a cap on that. In terms of credit bureau scores or any guidance you can give, that's question number one. And question number two is that you'd also mentioned some write-offs from the MSME book. So can you guide in terms of how the MSME book is looking at what particular part of the portfolio you're concentrating on, and is the write-off more than in the retail portfolio? That's it from my side.
Sorry. First question we could not hear properly, the first question.
Okay, so on the individual loan, it was a pickup from the previous question. Are you seeing, how many of the customers are new to credit and how many are new to Ujjivan? If you have some color, or if they're new to credit, is it like, higher bureau scores, or is there any difference in customers compared to the past? That was the first question, sir.
Okay, so on the individual loans, right, we have new to Ujjivan is about 17%. And new to credit would be I would say I don't have the exact numbers, but in the range of 10%, not more than that.
Okay, so
On the individual range.
okay, and the profile of the customers remains the same pretty much, right? In the sense, there's no difference. In the sense, are you migrating to higher quality credit quality customers or something?
So, as far as our acquisition strategy is concerned, we continue to have bureau scores above a particular threshold is a very hard cutoff. So we do not take any low bureau scores as far as new customer acquisition is concerned.
Perfect, sir. So my second question was on the MSME book. In terms of, you had mentioned some write-offs, so how is that book behaving and where do we expect to see growth in that book coming?
Our MSME book has, the new book that we have done in the last 24 months is behaving quite well. In fact, this is in completely in line with the industry. We still hold a book of about 4% to 5%, which is the pre-COVID book. The NPA on that is 4% to 5%. That is the book on which we have initiated a lot of legal initiatives, including for safety and other legal measures. That book has taken some time for us to recover. Most of that book is now in advanced legal stages. I would say 90% of this book is in the advanced legal stages. We expect that, in the next 2 to 4 quarters, we should see some significant recovery coming from there. So that's the sticky pool that was pre-COVID, which we continue to have on the book. Otherwise, on the new acquisition, it has been very good. And in terms of the growth of the book, we mentioned that the book MSME business has started to see pickup. Product launches have been done and hiring has been done. Technology upgrades is in process, and phase-wise they will also get capitalized and get launched. And in terms of fintech partners, we have already started working with fintech partners. One was added this quarter, and we are looking to add more. So the business will see a good pickup in the coming quarters.
Perfect, sir. I wish you all the best.
Thank you.
Thank you. The next question is from the line of Shailesh L. Kanani from Centrum Broking. Please go ahead.
Good evening, everyone. Thanks for the opportunity, sir. All my questions have been answered. Only one question, sir. Just wanted to understand, post the NCLT verdict, assuming that the reverse merger verdict goes in our favor, so what is the next steps from Jan to March, if you can highlight those steps?
So we'll receive the NCLT order challenge, and basis that will move for will notify the other regulatory bodies and will set up for a record date. The shares will be issued, and there will be a small window where the trading will be suspended for the existing shares, and the new shares will be listed. All in all, as Mr. Davis mentioned, we should be able to finish it by March of this year.
So just to clarify, there will be no further approval needed, right? After this approval, just wanted to clarify that.
Sorry, Shailesh, we couldn't hear you.
So I was asking, there will be no further approvals needed, right? After this order, it will be more of administrative work.
Yeah. It's more of procedural in nature.
Okay, fair enough. Thanks a lot. And also one question, our book value stands to be increasing by the same percentage, around 2 to 3% post this reverse merger. Is that understanding right?
Yeah. So the book value you are asking, right? Post reverse merger?
Yeah.
The book value should go up by 2.4 to 2.5. One-time increase should be there.
Okay. Thanks a lot.
Thank you. The next question is from the line of Himanshu Taluja from Aditya Birla Sun Life AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. Just one question at my end.
Sir, since it's the start of the year, you have given the credit cost guidance of 1% for FY24, and most of you are going to hold within that. Based on the current trends, as the credit cost is also normalizing, how do you, any guidance if you want to give for FY25? How one should see the credit cost trends for the next year?
I think it's a little early for us to give you a guidance for next year, but anything in the range of 1.25 to 1% is what we can say.
Because hi, Deepak, can you be a little bit louder? Sorry, I can't hear you.
Is it better now?
Yeah.
Okay. So, since our slippages have been very minimal in the last 2 years, the upgrades in the next financial year would be lower than what we have seen in the last 6 quarters. So to that extent, the credit cost could move up marginally. This year, let's say it's below 1%. Next year, it will be higher than 1%. So maybe in the range of 1.25 or something. But it's a little early for us to give you an exact number. We can talk about a range of 1.25, 1.3%.
Okay, sure. Thanks.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Sir, most of the questions have been answered. Just one thing on the bad debt recovery. So this year we have done around 105 crore, and you mentioned that you have a pool of 800 odd crores left. So what could be the sort of recovery that we are penciling in for the next couple of financial years from now?
So bad debt recovery typically in the range of 25 to 30% within 24 months is what we have experienced. Now, a lot of the pool that we have written off is more than 24 months, so we believe that it will be lower in that pool. Our incremental bad debt write-off, write-off has been very low this year. It's in the range of 0.6%. So our bad debt recovery for next year, the outlook is going to be lower than what we are going to do this year.
And that should continue for a couple of more years from there, right?
It will be surely lower than what we got last year and then what we started in this year.
Sorry to interrupt, but you are audible, sir.
Last year, we got write-off recovery of about 130 crores. This year will be marginally lower than that, but in the same range. But next year, the bad debt recovery would be lower than this. Because our write-offs have been going down, so the recovery in terms of absolute numbers will also come down.
Understood, sir. And one thing on the cost to income, so it has gone up in this quarter. Is there any change in the mix also which is causing this higher sort of a cost to income, or this is more to do with the higher number of branches and personnel that you have hired, which has caused this?
There are a couple of things that you need to see when we talk about cost to income ratio. One, the income on the other income this quarter was flat, given the insurance income was high last quarter. So there is no one-off in this quarter on the income side. Cost of fund continued to move up, so which is why there was a decent jump in finance cost. And on the OPEX side, there was a ESOP cost which was there. So netting all these three, the movement in cost to income ratio was not as steep as it looks like. It's like 275 to 80 bits. This is the reported number, but netting off the numbers, that three reasons that I mentioned, it would not be as high. So it is in line with what we have guided earlier, that we will be in this range for the full year. And Q4 should be improvement.
And what could be the rough range of this ESOP cost that you are talking about? Very rough number.
I have mentioned that twice on the call. I need to check that and come back.
Understood, sir. Okay, sir. All the best. Thank you.
Thank you. Ladies and gentlemen, we will now take 3 more questions. The first from the line of Amay Ashok Kulkarni, an individual investor. Please go ahead.
Yeah, hi, good evening. One of our competitors from Karnataka. Hello? Yeah, hi. See, one of our competitors from Karnataka has reduced interest rates. Are we seeing any significant increase in competitive intensity? Do we expect to reduce interest rates for the group loans?
Yes, one of the large competitors has recently announced a rate cut in their microfinance business. We do not expect too much of a change on the ground in terms of competition.
And see, we have been guiding for a credit cost of approximately 1% or less than 1%. That comes to approximately 250 crores. So these 9 months we have done a credit cost of about 160 crores. So any guidance on what could be the tentative credit cost for Q4?
We'll maintain the guidance that we have given rather than giving any absolute number. We will continue to be below 1% is what we have said, and we will stick to that, below 1% only for Q4.
Okay. Thanks.
Thank you. The next question is from the line of Arvind R. from Sundaram Alternates. Please go ahead.
Hi, sir. Thank you so much for the opportunity. I would just like to understand, what are the new product launches that is coming up? Obviously, outside MFI, we are growing our affordable housing loans very fast. And as you said, we will be launching, gold loans and vehicle finance loans. I'd just like to understand what other products, are in the pipeline. And I would also like to understand what would be the yields in those cases, because there is a significant difference in yields in MFI loans and affordable housing finance loans. I'm just trying to understand if these products would be somewhere in between. Is my first question, sir.
Okay, so we've been into this business, catering to the needs of the aspiring middle class. So our new products are also designed for the same segment. Therefore, a logical extension to that is we do gold loans, which we have tested, and we will be scaling up in the next financial year. Two-wheeler loans is something that we are already doing well now, and we will scale up again that product in the next financial year. In the same segment, we also launched a micro mortgage product, which we have already started to scale in this year, and we have started to see very good response to the product. This is again a product which we will scale in the next financial year. Other than that, on the MSME business, we will be launching the working capital product for manufacturers and traders. That is expected to be launched in the beginning of the next financial year. Other than that, we've been doing secured agri products, which is in the form of KCC. This is something that we've been testing, so we believe that we are ready for a scale up on this product also.
What would be the typical yields in these products, sir? I mean, because we have two completely different levels of yield. I understand the nature of the product. I'm just trying to understand where would the yields be in this new set of products. What kind of range it would be?
Voice was a little muffled. Could you please repeat the question?
Interest rates will be market competitive. Is the question on the interest rate, yields and all that?
Yeah, yields on these kind of these new products that you're going to launch, or which is in the stage of scaling up. I'm just trying to understand what would be the typical yields in these products. Yield or interest rate on these products.
Would be competitive. The interest rates would be industry competitive interest rates. Typically, two-wheeler and micro mortgage are on a higher yield businesses. Gold is a medium kind of a yield business. MSME, as you are aware, would be very competitive and within our product basket on the lower side.
Okay, sir. Okay, sir. And any guidance on like mix, sir? Mix of MFI and non-MFI by FY24, FY25, FY26?
We had given March 26 secured, unsecured guidance of 40/60.
Okay, sir. Okay. And just one last question, like any long-term guidance, any change in long-term guidance on cost to income? Like since we are like continuously investing in the franchise, do we see any upward revision to cost to income ratio in the test?
Our long-term guidance for FY25 and 26 was given in our analyst meeting done in June 2023, and we stick to that. We had given a ROE guidance of 22% plus, and we stick to that.
Sure. Thank you.
Thank you. The next question is from the line of Manish Ostwal from Nirmal Bang Securities Private Limited. Please go ahead.
Yeah, thank you. All my questions answered. Thank you.
Thank you. Ladies and gentlemen, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Well, thank you very much, Gavin. And I'd like to thank IIFL and Rikin Shah for organizing and sponsoring this. And thank you to all the participants for joining, and appreciate all the questions. And we look forward to seeing you in the next quarter. Thank you.
Thank you. On behalf of IIFL Securities Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.